After 2 days of intense negotiation in Switzerland, the US and China agreed to temporarily lower their tariff on each other's import for 90 days while working towards a broader agreement. Treasury Secretary Scott Bessent stated that both sides agreed to avoid a full decoupling. Instead, the US will be pursuing a strategic decoupling limited to sectors tied to national security, such as semiconductors, medicines, and steel. So it's going to be a more precise approach. Only the industries that Trump's administration want to bring back to U.S. will be decoupled. So Bessent also said he wants to see China boost consumption and open up their market to America. So both countries need to strengthen their domestic circulation. Right? For U.S., they want to bring some manufacturing capability back into the country to increase that internal circulation. And same for China. China wants its consumer to spend more money in domestic produced product, also increase its internal domestic circulation. This is actually aligned with China's current dual circulation strategy, which was first brought up by the Politburo Standing Committee of the Central Political Bureau in the year 2020. As a result of the revised negotiation, both sides will be lowering tariff by 115%, which means the U.S. will lower its tariff from the current 145% level down to the 30% level. So within the 30% tariff, 10% is the base tariff, while the remaining 20% is a fentanyl-related tariff imposed earlier this year. Bessent also said if China acts on fentanyl, perhaps this fentanyl tariff could come down. For China, the tariff for American imports will be reduced to 10%, down from 125%, and this outcome is significantly better than Wall Street's expectation before the negotiation. Goldman Sachs anticipated both sides to lower their tariff to around 60% level, but in reality, it's a lot better than the anticipated 60%. Apparently, we're down to 10 and 30%. As a result, we're seeing S&P 500 down here is up 2.7% as the market opened, and VIX up here is down to 19. And we're also seeing some strengthening of the US dollar and the weakening of gold. This is because some of the capital outflow from US is being reversed. Right? Money used to exit US, go to somewhere else. Now that action is being reversed. Currently, the baseline U.S. tariff rate is at 10%, according to the White House press secretary. This is considered the minimum tariff level, even after making a trade deal, as seen in the U.S.-UK agreement, where U.S. kept a 10% tariff on the broader UK imports. So if China eventually is able to get a U.S. get a trade deal with U.S., the U.S. tariff on the broader Chinese good will go down to a minimum of 10%, because now the 10% tariff rate is the new zero tariff rate. This approach aligns with Trump's MAGA agenda, which is to maintain some sort of trade barrier to protect the domestic manufacturing. A day ago, a mainstream media, for example, this one is Financial Times, they're still highlighting the ongoing capital outflow from the U.S. Despite the S&P 500, it's the pink line in this chart, recovering all the losses since April 2nd, reciprocal tariff day, or the Liberation Day. The European stock market has been outperforming the U.S. equity this year because of so-called the capital outflow. A lot of money exited U.S. to enter Europe, to enter anything non-U.S. like gold or Bitcoin. Bitcoin is now at $103,000 per piece. That's pretty much near the all-time high. The mainstream media often attributes the current U.S. capital outflow to policy uncertainty due to the new administration, and there's the dollarization effort going on globally, and there's a declining trust in the U.S. government. However, a more fundamental explanation lies in the balance of payment theory. So if Trump's policy are expected to reduce U.S. trade deficit, this would improve the trade balance. So according to the balance of payments theory, this will potentially leading to a capital outflow as a natural phenomenon. While the media narratives continues to emphasize this outflow of capital, I think the investors needs to be very careful about trading this because number one, they have been talking about this for a while, right? If some new trend happens, you need to jump on the wagon early. If it's already been talked about for a while, right, it's most likely going to be late. And secondly, the U.S. stock market is a discounting mechanism where today's price reflects the expectation in the future. So it's possible that today's price of already priced in the worst case scenario where there's a full decoupling between China and US and there's a high trade barrier between US and other major economies. So maybe the worst has already been priced in. And if the events coming in the future are positive, that's going to reverse a lot of this US capital outflow. Right? For example, what happened today when China-US strike a deal better than the anticipation, the trade barrier was lowered than the expected 60%. That's going to drive some of the capital inflow. And this example can be seen in the gold price, right? Today we're seeing some money exiting gold coming back to US, right? So it's important to, I think, for investors to stay diversified across different asset classes. For example, equity and cash equivalent, those are two asset classes, and maintain a balanced exposure that aligns with your personal risk tolerance. Okay? Your personal risk tolerance. Everybody's risk tolerance is different. So rather than reacting emotionally to the headlines and market projections, I think long-term investors should, once you find that your risk tolerance, right, translate that into a cash percentage in your portfolio, and then stick with that strategy and stay patient. So far, all the hard data in US remains strong. The US economy continues to show resilience, while some argues that the tariff policy have a delayed effect on the economic indicators and reports, but there is no clear sign of weakness yet. So both CPI and non-farm payroll data remain solid. Another key indicator I closely monitor is the unemployment benefit, especially the number of people receiving the unemployment benefit. This is so-called initial claims and continued claims, right? But this one we're looking at is the continued claims because this is a high frequency data, right? This releases every week. So the initial claim data only captures the new claims within 1 week. So anything older than 1 week, right? Anything older than 1 week gets translated into the continued claims. So all we need to look at is continued claims. It's a very high frequency data. So the continued claim on this chart, as we can see, the shaded area is the previous recession time, and chart starts from 1985. So if at each beginning of the recession, we mark that level of the continued claim number, right? And there's one here, there's one here. You're able to draw a trend line, right? So that trend line, we can call that a recession indicator in the continued claims report. And our current level right now is at 1.87 million. It's a lot lower than the projected 2.7 million recession indicator level, which means this data alongside non-farm payroll data is strongly suggesting that there's no sign of recession in the labor market at this time. Thank you very much. Please like and subscribe.